those are my targets. I think I'm probably going to be proven conservative on those targets. So gold at 4,000, I may have to raise that. We're not that far away, frankly.
We're right there.
Um,
Yeah.
silver's quite a bit away from my target, but I think as we saw in 2011, when silver gets going, it gets going in a hurry. So if you want to talk about a parabolic, that can go that way. So I'm pretty comfortable with both those targets. Like I said, I may have to raise my gold target. And then in the bust, I think they will, like all assets, get hit. Won't get hit like the stock markets. At least gold won't. Gold. Let's say gold goes to.
The financial markets seem to surprise everyone every few weeks. Silver keeps rising, gold keeps setting records, while the S&P 500 reaches all-time highs. Investors are torn between fear and hope. However, few Wall Street voices are as audacious or contentious as David Hunter's. Hunter, who is well known for his contrarian predictions, believes that the markets will experience a catastrophic last meltdown before a similarly dramatic disaster that could completely alter the global economy. We're about to enter the last phase of a historic supercycle, which Hunter says will see commodities rise, equities soar, and inflation spiral out of control before the largest bust in human history. He thinks that once central banks lose control and start pumping trillions of dollars in additional stimulus to combat deflation, gold may finally hit $20,000 and silver $500. Don't forget to like, subscribe, and ring the bell for the latest analysis on gold and silver markets. We'd love to hear your predictions. Drop a comment below.
They don't necessarily have to be totally in sync with the stock market. So the stock market could top out before the end of this year or early next, and precious metals might go, a couple months beyond that. But those are my targets. I think I'm probably going to be proven conservative on those targets. So gold at 4,000, I may have to raise that. We're not that far away, frankly.
We're right there. Yeah.
Silver's quite a bit away from my target, but I think as we saw in 2011, when silver gets going, it gets going in a hurry. So if you want to talk about a parabolic, that can go that way. So I'm pretty comfortable with both those targets. Like I said, I may have to raise my gold target. And then in the bust, I think they will, like all assets, get hit. Won't get hit like the stock markets. At least gold won't. Gold. Let's say gold goes to. And I haven't raised my target, so I'm not saying this, but let's say it goes to 4,500. It could go back to 3,000. That'd be a 1/3 retracement, right? So that's a lot less than 80% retracement the stocks will see, but it's still a big hit. Silver, which is much more volatile and much more economically dependent, if we go to 75, you might see that back to 30 or below. Might even go back to 25. So they will be hit. As I say, I'm a huge bull on the precious metals post bust. I have a target of 20,000 on gold for the early 2030s, not 2030, but the early 2030s, and silver 500. So I'm obviously those are huge numbers, and those that say I'm not a trader, I'm just going to buy and hold. If you do that, just know that in the bust, you're going to get hit, and you might get cold feet at the wrong time. You might, once it's down 30 or 40%, say, hey, I don't know, maybe it's going to go down more. I'm getting out. So maybe better to take chips off the table and wait for the bust to happen and then get back in. As I say, it's kind of like standing on the south rim of the Grand Canyon and looking across to the north rim and thinking you can walk straight across. There's this canyon in between called the global bust that's going to influence your thinking all the way through. So, okay, so I think institutions, obviously they're all over the lot. The hedge funds probably are more aggressively defensive. I don't track it closely, but I'd say lots of institutions are in more defensive stocks. They may have a higher percentage in the shorter end of the curve because they haven't been big bond bulls either, but they may be stretching that out and adding duration to their bond portfolios. I think just in general they're more defensive than they will be in the next few months. You're just beginning to see, I think, that they recognize this thing could have legs. As we talked about before, the Fed is just starting an easing cycle. So in their minds, that may be, even though my view is that we're approaching a top, the institution, and I expect in the next few months, the institutional view to be that we have a couple of years to run here, and that with the Fed at our back, it's time to get more aggressive. So, they'll get less defensive in their stock portfolio and probably add more equity allocation. All institutions do it differently, so I can't really say. So the dollar, my current dollar view, and it's been my view for a few years, is that we in this decline in the dollar from 115, back in 22, I have been saying we could get down to 82. So I think between now and sometime in the first half of 2026, we'll see the dollar down to 82. Probably more likely first quarter next year, but who
Whoa.
knows? So,
Yeah.
meaning between now and the end of the first quarter.
Yeah.
So that's a big drop from
That's a
here.
big drop.
I
I
think
don't mean to interrupt you.
the next step, because we've been consolidating around the mid 90s here for a little while. I think
Right.
it's pretty soon we're going to see it roll out of that, and the next step is 90ish, and then we'll have another leg down to 82. I think probably next year, and then in the bust, at some point in the bust, and not early on in the bust, the dollar can get hit. Later on in the bust, I think you'll see a flight to safety, as we always do, into the dollar. So I think you could go all the way from 82 back up to 120. And again, if we're talking about an 80% decline in the stock market here, imagine what the story is around the world. And if Japan blows up, if China blows up, if Canada has real problems, if Europe has real problems, there's not going to be very many places where foreign investors can go. They'll be coming into our treasury market in a big way. And that's the funny thing, is the narrative out there has been all about what do we do to replace the foreign investor. I go, that's not my worry at all. We don't need stable coins. We don't need anything else, at least in the next year to 18 months. There's going to be plenty of demand from both the Fed and foreign investors, along with domestic investors, institutions. There won't be enough treasuries to satisfy all the demand. So that's why you get a big drop in rates. But so anyway, I think the dollar can have one last run to 120, and then post bust, I think we begin a long decline, and part of the long decline is I believe we're yes, we're in the end of a 43-year secular bull market in stocks. I think we're also in the last decade of a super cycle, big macro cycle, and I define a super cycle as the big cycle between two depressions, the 1930s being the last depression. I think the 2030s, probably mid 2030s and beyond, being the next depression. So we're in the last decade of a super cycle, and everything goes crazy. That's why we've seen what we've seen in this last 5 years, and really the last 15 or 20 years. But and it just gets more extreme. What it's going to take to pull us out of that bust, in my opinion, is probably going to be something on the order of 20 trillion in new QE. That's just the Fed, proportionally similar around the central banks around the world.
David Hunter highlights the stark differences among investors in the markets. While retail investors became positive much earlier, large institutions have been cautious since the 2022 low. By the end of this year or the beginning of next year, Hunter thinks the S&P 500 may still rise by at least 30%. Although inflation remains above target and growth is decreasing, Wall Street traders are unconcerned. It seems like every day that stock prices continue to reach new highs. Even Trump's harshest opponent, Jerome Powell, acknowledged that equities are fairly highly valued, despite the fact that they are incredibly costly by historical standards. Hunter cautions that there might be impending major trouble because of this. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
You have a really strong end of the year with Wall Street bonuses, but is that your guesstimation here?
Yeah, it's got nothing to do with Wall Street bonuses, or very little to do with that. I think what it is you've had the institutions from certainly from October of 2022 all the way up from the bottom at 3,500 on the S&P. The institutions have looked at this very skeptically and said, we're not. First they thought it might go a few hundred points, and then when we got up to the old highs at 4,800, they said, okay, maybe we go a little higher. But they were looking at it as a bear market rally until then. Then they said, yeah, okay, I accept we're in a bull market. but they didn't think it'd go a lot higher, and then they kept raising targets. And now you're starting to see a sprinkling of them say 7,000, but most of that is out a year. I mean, so most of them are kind of concentrated in that mid 6,000s range, 6,500, 600, 700. And that's a far cry from where they were just a few months ago. And they remain cautious. I think they remain skeptical. Yes, they're acknowledging that they've got to get on board, that the momentum is there, but they have one foot out the door all the time. I think until that changes, you're still in a healthy bull market. So yes, we're getting to the end. We could be a few months from the end of a 43-year secular bull market, and I think the highs of this bull market will probably stand as the highs for decades. So we're not very far from a top, and yet, my targets are saying that we have, at least 30% and maybe even more upside from here, and that we might get that all before the end of the year. Doesn't have to, as I say. The market could top out before the end of the year, or it could push into first quarter of next year. As I say, the market doesn't turn into a pumpkin on December 31st at midnight. So, calendar doesn't really matter, but I would not be surprised if we cover that whole big run up in this year. So retail has been remarkably from Liberation Day last April, the bottom. The retail has been surprisingly bullish, while the institutions were very bearish. In the early April when we went down, had that 20% swoon. I turned bullish below 5,000. I turned more bullish. I was already talking about 8,000 on the S&P. I raised my target below 5,000 when everybody else was lowering targets and saying we're in a bear market now. The top's in. I said we're going to 8,700. So I raised at that time, and that's how I'm a contrarian. That's how I work. As the sentiment got so negative, I got more bullish, and that's the same story here. Is that the institutions remain skeptical, and that what I call wall of worry is the fuel for the future advance. So what you don't want is everybody all in. Once everybody's all in, that's already been acted on. So the reason I'm so bullish is because, again, in spite of the fact that we're at all-time highs or very close to all-time highs right now, sentiment remains subdued. And that means there's plenty of there's plenty of fuel for future advance. We've seen the rates move down from, say, I think they backed up to 460 or up in that range, and they backed down to maybe 4% on the 10-year, very close to it. And then in the last few days, we've backed up to 414, 15, and could go a little higher here, but ultimately I'm calling for in the next 3 to 6 months, you could see rates certainly down towards 3% and maybe even below 3. And then from there, I can see a 0% 10-year in the global bust that I'm forecasting to follow this. So I think we've seen the highs in rates for a while, for at least the next year or 18 months. It's pretty much that's gonna help fuel the market. Part of the reason the bond market's moving down is because the economy is slowing. Another part of it is because inflation, despite the Fed's worries and some on the streets worries, inflation continues to trend down. I think we will see, ultimately, we will see 2%, which is Fed's target, and then below that in the next year. I'm saying that the global bust that will follow this will bring on deflation. So we'll have truly the first deflationary downturn in 90 plus years. So everybody else is worried about inflation ticking up. I'm saying no. Yes, we've had a couple months of tick up or uptick, but really the trend is down and it remains down. So I think that if inflation's moving down, the Fed's been too restrictive. They've got to catch up. And as I always say, the bond market sees this stuff well before the Fed. The bond market moves. I'm not really worried about how many cuts we have between now and the end of the year. I'm not worried. I wasn't worried whether the Fed was going to get a quarter or a half in September. The bond market's going to take care of that. The bond market in its aggregate is a far better forecaster of what's to come than any Fed official.
According to Hunter, the bull market is actually being sustained by this persistent pessimism. He clarifies that there is still potential for price increases as long as the majority of investors exercise caution and refrain from going all in. According to him, the market is driven by what he refers to as a wall of worry, or the hesitancy and uncertainty among institutions that compel them to purchase more as prices rise. While the experts continue to have doubts, retail investors have shown a surprising amount of optimism since the lows of 2022. He claims that this disparity is the ideal precondition for yet another significant upward shift. Before this bull cycle ends, he believes the S&P 500 may still rise by 30% or more, possibly reaching his long-term target of 8,700. The market might peak later this year or early next year, so he doesn't expect it to implode just because the calendar changes. However, he cautions that the next significant peak may last for decades because we are approaching the end of a 43-year secular bull market. Hunter thinks that interest rates have already peaked. He anticipates that 10-year treasury yields, which peaked at about 5%, would decline to about 3% and perhaps lower within the next 6 months. He believes that eventually, during what he refers to as a global bust, yields may drop to zero. He says that the decline will be caused by a combination of panic demand for secure assets like bonds, slower GDP, and declining inflation. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date. Thanks for watching.